Hi everyone, I think we're live. Sorry for the short delay. Welcome to week 8 of Introduction to Digital Currencies, Fall 2021. This week's topic is financial institutions and central banking and how they relate to cryptocurrencies. Hi everyone, I think we're live. Sorry for the short delay. Welcome to week 8 of Introduction to Digital Currencies, Fall 2021. This week's topic is financial institutions and central banking and how they relate to cryptocurrencies. Hi everyone, I think we're live. Sorry for the short delay. Welcome to... Okay, I think I had an echo going on there. Is everything okay now? Dimitri, am I okay now? Got it. Okay. Well, take 2. Let's jump into the questions. It's nice to see everyone again. I know it's been a few weeks that we have not seen each other. So let's actually have a good series of questions. I think we'll be able to use the time on the questions we already have. And so I'm just going to jump right in and try and get through them all. First question is the following. The slide deck states that CBDCs are the only true stablecoin. Everything else is a deviation away from the perfect stablecoin. I'd argue this perspective is completely ingrained in our brain and is the only reason political loyalty is still existent. Fiat currencies, also monetarily equal to their respective sovereign CBDCs, are debased through irresponsible monetary expansion at the expense of the lower and middle classes. The US dollar, for example, is worth 9% of its value from 1950. Furthermore, a CBDC denominated in USD is not even existent, so I would imagine the digital aspect of creating a fiat currency would have further devaluation. The slide deck may be referring to a USDC or USDT, for example, pegging to a fiat currency, but the big picture USD or USD CBDC is far from stable. If you can't tell, I am one who looks heavily through the perspective of monetary value versus technical value. Also, I'm a Bitcoiner, Austrian economics proponent at heart. I'd love to hear your thoughts on this and how certain tokens, networks like Luna Terra claim to solve the stability problem. Okay, I think this is a definitional issue, to be honest. When I say stablecoin, that's not a statement that relates to inflation or the value of the coin itself. And it's not what people mean when they're describing these things. What they mean is stable relative to the coin it's meant to replicate. So you can have a stablecoin dollar and a stablecoin yen and a stablecoin euro. And this isn't a statement that the dollar is stable or the euro is stable or the yen is stable. This is just a statement that the coin itself is stable relative to its reference, which is the dollar, the yen, the euro. So if the dollar, yen, euro has a lot of inflation, then this should have a lot of inflation. If it does not, then it shouldn't. And so this, I think it's a technical question, and I think it is not something we should get hung up on, right? Like the question of if the dollar has inflation, is inflationary and does it lose value, maybe an interesting question, right? I agree, it's an interesting question. My views are probably somewhere in the middle between the Austrians and the Keynesians, right? But that question is different than if we're going to represent
think it's a technical
as a cryptocurrency, what that means, right? If we represent it as a cryptocurrency, what it means is it needs to match the dollar. If the dollar devalues, it needs to devalue with the dollar. And the reason for this is you need, these currencies are still the unit of account in the major economies of the world. And so if you are working in DeFi, online, in cryptocurrencies, you do need things that match the unit of account of the country. And so the only job of a stablecoin is to stick as close as possible to a US dollar. Now, you say, I don't believe in the US dollar. That's fine. Buy Bitcoin, or buy gold, or buy shares of Apple, or buy Ethereum, or buy Solana, or buy real estate, woodland, commodities, copper. There's many things you can buy if you don't believe in the dollar as a currency that will hold its value. But you will need the composability in DeFi of something that represents the dollar, because the dollar is still a major part of the economy, right? You will have things and contracts that are priced in dollars, and you need a cryptocurrency that goes up or down with the dollar. Even if your belief is that the dollar is going to go down and it's going to lose a lot of value, that's fine. You can believe that, but you still want some way to represent that dollar. Even, hey, I'll take the extreme example. You believe you should short the dollar. Okay, great. You still need a cryptocurrency that behaves like the dollar so you can short it. And the only actor who can make something that behaves exactly like a dollar is the Federal Reserve. Only one. Can JP Morgan get close? Sure. Can some other asset-backed, like USDC get close? Sure. Is it exactly the same? No. There are some conditions where it will behave differently. Will the algorithmic ones get close? So far, the algorithmic ones have been a disaster. Right? The algorithmic ones have not been close at all. So the ones that are collateral-backed have tended to done better. The algorithmic ones have not done very well. And so but CBDCs will do a very good job of being a stable coin relative to their respective currencies. So that's what that means, and I'm pretty comfortable with that statement, actually. All right, let's go to the next questions. Are CBDCs really cryptocurrencies? I have multiple questions, just to be clear. What do you mean with the term public cryptocurrencies, the cryptocurrencies in the market? Well, I understand that cryptocurrencies and CBDCs are quite the opposite. CBDCs are central bank money adopting a digital form, unlike cryptocurrencies, whose end goal is known as DeFi, decentralized finance. It's true we can't expect central banks to issue their own digital currencies anytime soon, because most CBDCs are moving at a sluggish pace. Is it a sociological barrier to adopt a CBDC, not a technological or regulatory barrier? Are the commercial banks the real victims of CBDCs? Because of the CBDCs, what's the meaning of intermediaries like commercial banks? Well, there's a lot of questions in here. Okay, public cryptocurrencies. When I refer to public cryptocurrencies, and I think most people think of this the same way, think of it in contrast to private cryptocurrencies. And public cryptocurrencies means they're permissionless, means that anyone can join. Private cryptocurrencies or private blockchains are permissioned. You have an industry alliance of X banks, Y shipping companies, or maybe certain central banks, and they have some type of blockchain-based system, and that's a permissioned blockchain, a permissioned cryptocurrency, a permissioned system. Whereas the public ones, for me, are the permissionless ones. The CBDCs are not going to be public cryptocurrencies, as a general rule. I do not think, from what I can see in how they describe them, I do not think any country is going to be bold enough to go all the way to a full-blown public, permissionless cryptocurrency that is, in fact, their CBDC. I think they're going to have anti-money laundering requirements. I think they're going to have know your customer requirements. I think they're going to be able to block transactions. And so, in spirit, they actually might be very different than a Bitcoin, right? So, to the question of what type of barrier is it to adopt a CBDC, I think it's all both technological and regulatory and sociological and also executional, right? I mean, it is not a small topic to be responsible for the, central bank money of the country, and you generally operate on very long time frames, right? Like these public bodies and banks, when they want to do a technological upgrade in just the traditional world, those tend to be long time frame projects, lots of mapping, testing, etc., and it takes years, sometimes decades. Here, it's not only some big technical project, which it is, it's not some execution project, which it is also a whole change in framework on how they're used to issuing money. And that change in framework is something that is tied to something that they consider quite risky. Bitcoin, very risky. Cryptocurrencies, risky. And so the number of legal, regulatory, sociological, execution, capacity questions that come up are tremendous. And so I think it's going to be a slow process for them. In fact, I think they're moving faster than I would expect them to. Right? Like if you had asked me in 2015, would I expect public cryptocurrencies, anytime soon, public central bank digital currencies anytime soon? Not really. I think they're moving a little bit faster. I think they have gotten concerned by the growth of the crypto asset, cryptocurrency industry, and that has actually forced them to move faster than they might have under normal circumstances. So, strictly speaking, you can have a central bank digital currency and not have any blockchain whatsoever, right? You can just run all of this on a database, and you just have an account on that database, and that's the end of that. So we'll see how this all plays out, because they've all started, they're all planning to do it. It's unclear to me how open these systems are going to be, and it's unclear to me what the technology stack is going to be. And I think this is all in the design phase. I would say middle of the decade we'll start seeing this in some type of scale. How these interact with commercial banks is going to be a real question, because commercial banks do play an intermediary role, and that intermediary role is largely technologically driven based on how technology used to be. So imagine it's 70 years ago, you're in the 1950s in the United States, you're a vast country, and you have 12 Federal Reserves, and you're pre-internet, right? And you're pre a lot of things. Parts of the country just recently got electricity. And so in that world, you need to provide transaction banking to the whole country. And you're the New York Federal Reserve, you're the St. Louis Federal Reserve, and you want everyone in the country to be able to, do payments, write checks, and so on. How are you going to do it? I mean, you can't. You need the banks as intermediaries. You need someone to exist in every small town in the country, to have a bank branch, to go there, to deposit cash, to have a checking account, to send it from one place to another. And so this stack was built in a world that had very different capabilities for the remote banking. Effectively none. Now the banks are there, they're established, and now you could do it differently, right? Like if someone wants, you could theoretically give consumers access to the central bank directly, right? You have a website and you log on and you don't have to worry about counterparty risk if you want to deposit money with the central bank, right? The central bank can't default on you. And instead of this more complicated system where you deposit with a commercial bank and then there's deposit insurance and there's limits on it and a huge regulatory regime on those banks to make sure that they're safe enough to stay in the deposit insurance program. So you could do it. But can you do it? I don't know. That's interesting, right? Because there's other topics. Customer support. Is your country's central bank in a position to provide customer support to hundreds of millions of people? No, it's not. There's other topics. Loans. The country does need loans, and the central bank is not going to sit there underwriting your home mortgage or your personal loan or your credit cards. And so I think most countries are going to keep their commercial banks kind of in a form that they have them. And there you get into these questions of what type of systems are these CBDCs going to be? Are they going to be retail? Are they going to be wholesale, so only the commercial banks have access to them? Or are they going to be hybrid, that both of them have access to them? And these are tough questions. I mean, there's things I know, and I know very clearly, like that having a decentralized cryptocurrency like Bitcoin is an important thing for the world. Like, that I know. There's things that I know much less clearly. What should a CBDC be? Retail, wholesale, or hybrid? What function should the central bank take on in a CBDC world versus the commercial banks? I don't know. These are difficult questions because you can't just strip out one part of their business model without thinking about what happens to the rest of their business model. And this is also, I think, part of the reason that causes the delays, that people aren't sure how to handle these issues. So I think they're going to go slowly and cautiously. I have a question of, are central banks exclusively owned by their corresponding countries? I want to say yes, and I'm wondering if it's a trick question when it comes to the EU, right? Like in the United States, the central bank does belong to the United States, right? Now take the central bank of Greece or the central bank of Cyprus. It actually is quite limited in its actions by the European Central Bank. And the European Central Bank is not obviously Greece or Cyprus. It's not that country. What it is, it's a group of countries that have a currency zone. And in aggregate, the ECB and the national central banks are owned in a sense. I'm not sure owned is exactly the right word, but I understand the question. Are owned by those groups of countries. So it is interesting that way because sometimes there's a lot of debate in the EU and the 12, 11, 13 era. Excuse me. Of if the policies of the ECB towards the southern nations were appropriate. And it's a long question. It's outside the scope of this discussion. But there was some feeling, I think, from some people that decisions were made far away by people who had different interests and objectives than the folks that were impacting them. And there was a feeling of maybe the ownership wasn't there, I think. But so technically, And if we take ownership in the broad sense, like the right to manage how it operates, I think technically in a currency zone like the EU, it is not strictly accurate to say that all central banks are exclusively owned by their corresponding countries. They might be owned by their currency zones. Not central banking versus CBDCs. According to this article, almost all Tether is in the hands of very few people. In other words, it's very similar to central banking without accountability. Everyone's watching what the central banks is doing, but this is the first time I hear about Alameda Research. Is there any other option that covers the function of CBDCs or stablecoins, but with verifiable decentralization? So they're talking about USDT tethers, which is a private stablecoin, and by a wide margin, the most controversial. The Tether theoretically works in a collateral-based model that, like, each tether is backed by initially $1, and then they loosened it and said, well, other things that are worth $1. And then a few years ago, they had an issue where they lost some of their collateral. It's a long story. And an affiliated company gave them collateral to make it up. And Tether has not been the most transparent stablecoin issuer one could imagine one being. And there's always been this feeling that Tether was like minutes away from collapsing and causing all types of chaos in the crypto markets. And Tether kind of gives off that feeling, right? Like they're not hugely transparent in their communication. And then it never actually happens, and it just seems to go on fine. You should not think of Tether as a central bank. They don't have public accountability. It's a private financial instrument that purports to track the US dollar and has a variety of risks, including in the case of Tether, counterparty risk. The counterparty risk in the case of Tether is that they say it's asset-backed, but maybe it's not. Or maybe the quality of the assets that they're backing it isn't what you might hope they would be. So they say we're backed by US dollars. Okay, that sounds pretty good. Well, maybe not US dollars, maybe US Treasury bonds. That all sounds okay. The Treasury bond should hold on okay. But now they say, well, and none of this is true, by the way. Oh, they have bonds of Chinese real estate companies. Well, no, that's a little less exciting as something backing your US dollar equivalents. And then they say, no, that's just a rumor, that's FUD, that's not really what's going on with Tether. But Tether's not particularly transparent, so you actually know what's going on with Tether. So, yeah, it's a very interesting case, Tether. I think I'm going to use this to lead into the next question, that like, why is there such a push to crack down on stablecoins? Is it because CBs feel stablecoins will compete with CBDCs? Right. Maybe, I think it's a little bit different. What they'll talk about is that they're a risk to financial stability. And you're absolutely right. The central banks and the regulators are absolutely very serious about regulating stablecoins in a way that they're not about regulating Bitcoin or Ethereum or Solana or any other coin that trades on its own account. I believe their reasoning is the following. One of their missions is financial stability, and financial stability in their country or currency zone. And that means ensuring the stability of the unit of account and medium of exchange of that country, the dollar, the euro, etc. I believe their concern is if someone launches a private stablecoin and the stablecoin gets a high level of adoption and the stablecoin has a problem, this could spill over into what they would consider the real economy and cause financial stability problems in the real economy. And you saw this primarily, not with Tether or so on. You saw it with Libra, which was Facebook's stablecoin effort. And they got extremely concerned. And they got extremely concerned, I believe, because Facebook's very large, and Facebook has a lot of resources, and Facebook has a lot of capabilities that people launching Tether and so on don't. And Facebook has several billion daily unique users to roll this out to. And so I think that's when the light bulb went on. I said, wait a second. So Facebook launches stable coins, and they were doing one that was going to be like a global blended stable coin, and then pushes it out to 2 billion people. And everyone starts using that coin. Are we losing control of our own unit of account? Like, is Facebook suddenly becoming our central bank? They didn't like that so much. So I expect fairly aggressive regulation coming down the line for stablecoins. It is consistently their number one regulatory priority if you look at the statements. And I think it's for this reason. Like, I think this is the one part the state is going to, I think, be fairly aggressive about, is maintaining control of their own currency. And if the currency is going to be progressively more digital, they want to control the digital part as well. So I think that's my view on this. There's a lot of talk about Evergrande for the last few weeks, how potentially in a situation like this, the collapse of Evergrande affects USDT and then affects the whole crypto market at this point, right? This is what I mentioned earlier. The rumor is that Tether has a lot of Evergrande bonds backing Tethers. Evergrande is effectively a bankrupt Chinese property developer. And so the idea, to summarize the concern, Evergrande goes bankrupt, the value of their bonds drop, Tethers are no longer backed with a sufficient amount of collateral on a dollar-to-dollar basis. Chaos ensues, right? Now it's interesting the form of the chaos that might ensue. Because the logical thing to do if this happens is, of course, to sell Tethers. And sell them for what? Well, you're going to sell them for another cryptocurrency, right? And so, in the immediate case, you could imagine the price of like Bitcoin going up, right? Because everyone's trying to dump Tether. But then you think of other things. I mean, Tether is used in a lot of DeFi. It's used as collateral for places, in different places. If its value collapses, could it cause a variety of other chaotic events in the crypto markets? Yeah, I mean, I think so. I think if Tether collapses, if the price of Tether starts falling rapidly, I do believe we could have significant turbulence in the crypto markets. That's kind of bucket one. Now, will Tether collapse? Well, I don't know. Will Tether collapse if Evergrande collapses and Tether owns a lot of Evergrande? I don't know. Would we even know? I don't know. Right? I mean, this might all happen and Tether never tells you. Right? So, is there really any way to know? I don't know. So it's one of these interesting questions. Tether has been the source of a lot of crypto skepticism for a long time. And they continue to look like something's wrong, and then they somehow make it through to the next year. So, very interesting question. Is Lightning Network an alternative to approach a net settlement system in a Bitcoin payment ecosystem? I don't know how to answer that, to be honest. I mean, I guess the point being that it moves, the transactions are fast, and so you'll just grossly settle because they're going quickly and you're not tying up a lot of capital. I mean, maybe. I wouldn't think of it in this manner in the first instance. What Lightning should be is a way to make lower value payments practical in Bitcoin, right? Like, that's what I would hope we see from Lightning. The Lightning team and the Lightning derivatives they're working very hard. There hasn't been as much progress on, I think, layer 2 as in Bitcoin as one would have hoped. If you look at what has happened with Bitcoin and Ethereum, when we were teaching this course in 2014, there was no Ethereum, there was just Bitcoin. There was many other cryptocurrencies, but they're all truly Bitcoin derivatives. It was Bitcoin. I had slides and said, well, what could happen with Bitcoin? Store of value, okay. Could be a medium of exchange. And where would value come from? Well, how do you fund security in Bitcoin? And the answer was, well, if it becomes a store of value and it becomes more valuable, the block rewards will become more valuable. And that's one way to do it. I say, okay, but then it sounds kind of Ponzi-ish, like maybe we should also have transaction fees. Right, well, of course, you're going to have lots of transactions, you have transaction fees. But that is not how things have evolved, right? Like, the store of value narrative has gotten very strong in Bitcoin. The number has gone up to a level, I think, beyond most people's expectations in a fairly short period of time. I mean, going from $100 8 years ago to $60,000 today I think that was beyond most people's expectations. But the transaction case was far below most people's expectations. The transactions today in crypto are happening on Ethereum. And there's a variety of reasons for that. One reason is that the Bitcoin community has been fairly uninterested in transactions, I think is actually fair to say. There's one substrain of the Bitcoin community, but I'm not a big believer of the substrain. Like, spending Bitcoin on anything is kind of like a scam, right? Like, the best thing to do is just hold it and not spend it on anything. Like, it's the best asset, and just buy it and hold it. And look, it might be great, right? It's an amazingly well-performing asset. And that might be right, but that doesn't encourage a lot of transaction activity. Now, the counter case for people who are not of that model is like, no, just wait. You're going to get Stacks and Lightning Network, and you'll see a series of activity on Bitcoin To be determined. I mean, the transaction fees on Bitcoin used to be much higher than Ethereum. And then a couple of years ago, I remember when they were like, oh, well, they're similar. People weren't sure how to think about that. Let me post a link now on, am I allowed to post a link? Let's see. On what? Yeah, you look at cryptofees.info. You look at the last day's worth of transaction fees. It's wild, right? Like Ethereum had $57 million worth of transaction fees, and Bitcoin had less than $1 million. I mean, Uniswap had 10 times more than Bitcoin. Aave had more than Bitcoin. And so Avalanche is half that of Bitcoin. An Avalanche is less than a year old. And so there has been this interesting bifurcation that Bitcoin has moved to that digital gold model, and Ethereum is much more transaction oriented. And this has accelerated with the increase in dApps on Ethereum, starting with DeFi, now NFTs, coming soon gaming. There is a significant ecosystem that has been built on Ethereum that's quite active and generates a lot of transaction fees. And I don't know, it's an interesting question what that means. It is, there's multiple things it could mean, right? It could mean nothing. It could just mean that Bitcoin becomes digital gold and Ethereum becomes a transactional layer. It could mean that the transaction layer builds up a whole economy, and then Ether's value also is significant. It could be that all this stuff's coming to Bitcoin, but later. I'm starting to be more skeptical of that narrative, right? That was a pretty aggressive narrative in a few years ago. I'm starting to get a little bit more skeptical of that narrative. We'll see, but I'm getting a little skeptical. It's not what we expected in 2013, let me tell you. And it's interesting, some of the most fanatical, Bitcoin is only for this, or Bitcoin is only for that, and this is the one true way of Bitcoin people, are actually newbies. That's not how it was. That's not what we thought in 2013. That's not what anyone thought in 2013. This is revisionist history. And so I think from a broad perspective, it doesn't matter. It's kind of interesting from a broad perspective that you have two different communities and two different cryptocurrencies trying very different things. And so I think that's actually better from an ecosystem perspective. But it is surprising to me from someone who's been in the space a long time. I wouldn't have imagined this is exactly how it would play out. Is CBDC only state marketing, or will it have a great big innovation to the financial system and final consumer? What are the perspectives? I think it's an improvement. I think it will not be where the edge of innovation is, because it's going to be permissioned. And when you have permissioned systems, they just don't evolve as quickly as permissionless systems. So I don't think it's going to be the absolute place of digital currency innovation. But even if it isn't, I think it's not a bad thing for it to exist. I think having programmable digital state money is useful. Why wouldn't we want to have that? The bigger issue is not having it. It's what you lose I'll say one thing that does concern me about CBDCs and seeing the statements, both of the ECB, but also the BIS, the Central Bank of Central Banks, is that there is a tremendous orientation towards the main benefit of CBDCs is going to be censorship. That they can see transactions that they don't like, and when they have those transactions, they can block them. It's in all the marketing speeches. To me, the main benefit of CBDCs would be, innovation and lower cost of doing business and digitization of society. I mean, those things seem useful. A system where everything is censorable, if combined with elimination of cash, and here people have a lot of different perspectives on it. Some countries are more aggressive than others, but some countries have been quite aggressive about trying to eliminate cash. And then the problem with that is you're creating a system that is at significant risk of being used badly by the state, right? And so when you think about risks at a societal level, you're always balancing risks of bad actions by private individuals and risks for bad actions from the state. Democracies accept a variety of inconveniences and real life risks, crime, and so on, in the service of constitutional democracy and human rights. The state could certainly have less crime if they put a policeman in everyone's house, right? The state could certainly have less speeding if your car couldn't go over 100 kilometers an hour. The state might have less crime if they listen to every single conversation of every single person. And yet, in democracies, we try not to head in that direction. Because someone says, yeah, because of human rights. That's very abstract. I'll make it more tangible. You want to head not in that direction because there's a risk that the state might act badly, because the state is also people, right? There is question of who's watching the watchers, right? And that is, let me make it very practical. Let's say, which certainly some people in some countries would like this to happen, you eliminate cash altogether, you'll keep the banks, and you move to some CBDC for the permissioned CBDC for the things you used to do in cash. And so that Antonis Polemitis has this account number, and he spent $5, and what did he spend $5 with? The local kiosk, and he bought milk, and then he spent $100. He went to this hotel for the night. Everything is in one system. It sounds nice, right? They're going to say it's good for tax evasion, and it's good for money laundering, and it's good for preventing crime. And I think those things are true, actually. It'll be good for those things. But those are societal goods. The problem is, what happens when some dictator wannabe gets control of your country and manages to place his or her own people in charge of the system that decides who's allowed to transact with whom? Okay? Well, that's interesting, because you could end up with a system that person's enemies, political opponents, enemies, whatever, literally are incapable of buying themselves a bottle of water, let alone organizing an election campaign, let alone, competing in a democratic manner for a share of voice. And that hasn't existed before, right? Like cash is really quite decentralized, right? And that leads to some problems with money laundering, etc., tax evasion, etc. But it also is hard to hijack in this way. Whereas a complete CBDC system is hijackable. And I think there's a risk that the balance of power or the balance of risks between risks from individuals and risks from state actors, or again, individuals, right? Bad individuals who are using the state to their objectives, get out of line. And so I'm a little bit worried about this, to be honest, because I haven't seen too much discussion at the senior levels in the US or Europe of balancing these two things. So that's my view. It's the things that do worry me a little bit. I think there's another thing that less important, but they do. Some central bankers have talked about this. They want to eliminate cash and keep all money digitally. It doesn't have to be a CBDC. You can just eliminate cash and keep it in the bank, in order to be able to impose heavily negative interest rates. And they've given speeches about this. Because it's like, when the interest rate, like in Cyprus now, the university, the interest rate for corporations, a savings account, checking account, etc., is negative 0.5%. And I think for large individual accounts too. And, at that level, it's kind of annoying. But, okay, you can live with it. But if it was, negative 5%, I think the expectation is that people would start taking cash out of the bank and shoving it under their pillow than losing 5% of their money every year. There's other risks. People might come to your house and steal it, right? But, I think there is that expectation. And so some European central bankers have said, yeah, well, this is great. Well, we just need to prevent them from taking cash out, so we can go to negative, so I want to say negative 4%. I have to tell you, this doesn't seem very, like it's going to be very popular as a policy move, that you tell people, yeah, we're just going to clip 4% of your money every year. And, it's Keynesianism taken to the maximum. Well, people aren't spending enough, so we will make it unattractive for them to save, and we'll make it unattractive for them to save by taking their savings every year. But actually, in addition to the fact that I think it's going to be wildly, wildly unpopular, I'm not even sure that's going to work that way, because I think if people see their savings going down, they might try and save more, right? They might spend even less, and then you just get into some weird deflationary style spiral. So I worry a little bit that CBDCs done correctly, I think, could be a net positive for society in terms of efficiency and innovation. And done incorrectly, I think they risk, in some extreme outcomes, and I'm not saying these are the normal outcomes, but in some extreme outcomes, you could imagine some kind of dystopian type outcomes. And if you want to visualize what these would look like, I think you visualize some variation of what is already being built in China with the social credit system, right? That there is some interlinkage of a lot of centralized databases, that a lot of actions, one action ties to another action, ties to another action. Like, oh, you've not done a good job on X, you can't ride in the first class train or what have you. And that's a different system, right? It's a different political philosophy. I'm not saying anyone in Europe is trying to build that, or in the United States is trying to build that. But what is common among the two is that the technology is now there. Big data, machine learning, blockchains, to run really big, scalable, nation-scale financial systems, nation-scale messaging systems, nation-scale social systems. And there, once that happens, you have this question of how do you make sure that there's proper accountability of the people running those systems, right? Because there's some version where this is all very good and very nice and very democratic and is a force for good. And then there's a version where it's not good at all because it's unaccountable and decisions are being made somewhere in the bureaucratic structure and you don't know why they're being made, and they're not being transparently made, and they have a much bigger impact than they would have if these systems didn't exist. So I think we're at a very interesting time, actually. This is one of these topics that to the outside world sounds completely and totally boring. CBDCs, should they be hybrid or should they be retail or wholesale? But might have a very big impact on our lives depending on how they're designed. We're at the end of our time. I am going to have to cut off on time because I do have another place I need to be in 1 minute. I'm glad to be back. I hope to see you all next week again. I think we're meeting again next week. And please keep the questions coming. A lot of interesting topics. Thank you, everyone, and have a great day.